Hey, so today I'm going to derive the capital asset pricing model from a stationary or a degenerate Fokker-Planck distribution. So we're going to just assume that the market follows a multivariate Ornstein-Uhlenbeck process. This just means like there's some general equilibrium price, and it's kind of fluctuating up and down between this expected value or the expected return of the market and then minus the actual return. We're amplifying it by some theta, just the intensity of that mean reversion. Plus L is kind of Kolchinsky decomposed covariance. So everything here, R sub t, mu, theta, and L. And of course it's a square matrix, and it has to be positive definite, right? This D right here. And you can think of it as like instantaneous covariance. So let's just set this vector to equal A, and set the diffusion to be B. So here's our structure. And let's call it, this is a very familiar equation in statistical mechanics, which is the probability distribution with respect to time with these divergence expressions. And so we have the double divergence here that just turns out to be a Laplacian. But let's substitute in A, and we'll get this structure here. And what you'll notice is that this really is, if you're looking at it, it's basically a heat equation, right? We have the second order term is equal to this first order temporal derivative. It's kind of like, you can think of it like as a gauge transformation of the heat equation. So that's really the natural thing that's happening here, which means you can actually derive the Black-Scholes and the Fokker-Planck equation from the basic heat equation. But at stationary, we have the derivative of the probability at time. We're going to set it equal to 0. And so the detailed balance will imply that a 0 probability current as well. So we can go ahead and set that probability current equal to 0 and solve for terms. Move this P over here, invert this matrix, and then we'll get the gradient of the logarithm of the probability, as well as this kind of expected return minus the actual returns. So integrating this out, it's a familiar result. It's quadratic, so that means that it's the exponent of a minus of a quadratic. That's a Gaussian distribution if I've ever saw one. So yeah, let's go back to capital asset pricing, right? How do we interpret this? So we have that the expected value mu is equal to the risk-free rate times the identity matrix plus some beta of all of those different stocks. All these stocks are going to take on this value called beta. And we're going to multiply that by the expected return of the market minus the risk-free rate, pretty much. And we call this the market risk premium, right? We multiply that by the by beta. What is beta really telling us? Beta is telling us how similar this particular stock moves with the market, its covariance, and we want to see how much of the risk is it amplifying from the market. And everyone says like beta is a measure of volatility. No, it's not necessarily a measure of volatility. It's more a measure of systematic risk that you are taking, right? It's a correlation thing, but correlation is not causation. That's one thing you have to keep in mind. Like, low beta stocks don't mean that they're not going to fall really hard when the market crashes, right? It has nothing to do with that. If the market crashes, the market crashes. So, and then we can also, if we have a portfolio, we can treat this as the weight of the market vector of the portfolio times this covariance matrix. And that's an equivalent way of measuring beta with these vector valued functions. It's just easier to think of it that way than using this R. And so identifying the expected return as in the Gaussian process, that aligns with the Fokker-Planck stationary distribution. So look at this. It's just a Gaussian distribution of the capital asset pricing model, expected returns, with this variance. And so this is a solution, right, to the Fokker-Planck equation as a degenerate solution. And we can also take this m distance from, which is basically what was in that exponent up here previously. This is the m distance minus or besides this. And in our Gaussian, we can say that our the logarithm of the probability distribution is proportional to minus this distance times this amplification constant. And I guess phenomenologically, you could think of this amplification constant as like an arbitrage, right? It's restoring it's the level of mean reversion, or the height of it, basically, or the amplitude. You could think of something close. It's related to the amplitude, right? And so this just basically confirms that the stationary distribution concentrates at the capital asset pricing optimal portfolio, and so that's kind of a really interesting result. And it's the market portfolio maximizes the Sharpe ratio here. We know that. We take the maximum value that this takes on, and that would be the best in modern portfolio theory. That's like the best condition possible for our construction. So the optimal Wn satisfies that it's proportional to the inverse of the covariance matrix times the basically the returns that were expected minus the risk-free rate. And this is consistent with beta, our initial idea of beta. So thus the capital asset pricing model structure is embedded in the equilibrium solution of a mean reverting diffusion system. And so yeah, that's pretty much just kind of shows the application of these equilibrium thermodynamics. But maybe in another video we'll discuss what happens when you relax this assumption. But the whole point of this video is just to show that this financial model is embedded within the structure, or is a degenerate solution of the Fokker-Planck equation. So, thank you.